CEO and MD, Mr. Ajit Venkatraman, Executive Director, Greaves Cotton Limited, and CEO, Automotive, Mr. Arun Srivastav, Head Strategy and New Ventures, and Mr. Dalpat Jain, Group CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the opening remarks are concluded. Should you need assistance during the conference call, please signal the operator by pressing star and 0 on your touchtone phone. I now hand the conference over to Mr. Nagesh Vasavanhalli, Group CEO and MD of Greaves Cotton Limited. Thank you, and over to you, sir.
Everybody is keeping well and staying safe in these difficult times. I take the pleasure in welcome you all to Greaves Cotton Q4 earnings call. To begin with, I'll just give a brief overview. The detailed deck was passed out. Hopefully you have that. During most of fiscal year 21, our resilience was tested due to the pandemic and earlier slowdown of the economic activity. The team has shown enormous resurgence backed by a very strong strategy of diversification, right? This was mainly due to some of the business decisions and operational strength that the company focused on the things we control, building efficiencies and bringing new avenues of growth in the future. Some key highlights include, but not limited to, non-auto, e-mobility and retail. Some of our newer areas of business as part of our strategic pivot a couple of years ago in terms of diversification have now contributed to 30% of the overall revenue. So 30% of the revenue in a quarter when shared mobility or our core auto engines is down significantly. The new businesses have contributed to 30%. Again, that trend continues quarter on quarter. Company continues to maintain a strong net cash position. And as always, with the Greaves Cotton scheme of things, CapEx and R&D and other staff are funded through internal accruals and robust cash management. We definitely believe that the slowdown in one segment, in our case shared mobility, has been overcome by the growth momentum in several other areas. And our focus will continue in some of these other areas. For example, in non-auto, the auxiliary power segment of the genset division had a good market share increase and a good growth, partly because of the opening of the economy, but also because of new product offerings, i.e. the Genius genset or the smart genset. Aftermarket segment has returned to pre-COVID levels. Our e-mobility segment continues on its robust growth trajectory, almost doubling its top line. As a token of our commitment and our transition to forward-looking future businesses, Greaves has committed in setting up a state-of-the-art EV manufacturing facility at Ranipet. You will get to see a glimpse of how that plant will look. And we are working furiously on getting that started and getting incremental capacity. So we've also transitioned to phygital multi-brand retail outlets. Even in the middle of pandemic, we continue to add that. Ampere today boasts of 328 outlets. There are one caveat, although there are a lot of green shoots when I look at Q4, the second wave of COVID and ongoing lockdowns obviously will have an impact on Q1. With that, I hand it over to my colleague, Mr. Jain, who will walk us through the financials. Thank you.
Good. Thank you, Nagesh. Good morning, everyone. As Nagesh mentioned, FY21 has been a story of two halves. First half, where the entire economy and business were severely impacted by the COVID. And it's the second half where we saw business recovery and financial performance coming and moving back towards pre-COVID levels. I'm happy to mention in Q4, company reported a 35% growth over last year's Q4, and we had a total revenue of 520 crores. Company's EBITDA was 42 crores at consolidated level, and it had a PAT of 14 crores compared to 1 crore in Q4 of last year. In the second half, which is more comparable, company reported a revenue of 1,015 crores, which was a growth of 12%, and EBITDA of 91 crores. During the pandemic time, what company has been able to manage its working capital cycle. So overall working capital for the company came down to 11 days, and that helped company generate operating cash flow of 169 crores in financial year 21. We ended the year with 273 crores of cash and cash equivalents, which will help company in continue to be able to fund its expansion opportunity. Overall growth in e-mobility, the revenues almost doubled. From 34 crores last year, we reported 69 crores in Q4 of FY21. Company will continue to focus on its robust cash management and efficient conversion cycle as we move in FY22. There are headwinds from wave 2 of COVID, which shall impact the company's financial performance maybe in the first quarter of FY22. But as we move forward, the profitability trend will continue to remain in the positive trajectory. With this, I'll open the floor for question answers, and we'll be happy to take the questions from all of you. Thank you. Stay safe.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Alok Nath, an individual investor. Please go ahead.
Yeah, my question to the team is Ampere electric vehicle was already into the market almost 5 years back itself. So now, after Greaves Cotton has acquired the company, now what are the steps you have taken in terms of the competition from the other peer sector? 2 years back itself, now other major two-wheeler manufacturers like Tata, Bajaj, Hero, all these also started entering into two-wheeler electric segment also. So the competition in this segment is increasing. So coming to the price perspective or the other innovations kind of perspective, what are the plans from the Greaves Cotton team to take neck to neck and increase their market share? That's my question.
Sure. So hi, Arun here. Good morning, everyone. I will take this question. So one fact correction: Ampere has been in the market for almost 12 years now. So it's one of the pioneers in the electric two-wheeler space in the country. And we acquired Ampere in 2018. And when we acquired Ampere, that time the business was, around 18 crores in value, and which we have steadily grown over the past 2 to 3 years. And in terms of our strategic approach, Ampere has been targeting the mass market segment, which is the middle of the income pyramid, where bulk of people mobility happens in the country. Towards this end, in the past few years, what we have done is we have expanded the product range. When we acquired Ampere, Ampere had only slow-speed lead-acid-based products. Today, Ampere has increased its portfolio to a much wider portfolio, which covers not just the slow-speed segment, but also the higher-speed segment, and also increased its presence in the lithium-ion space. And today, when we look at the market, the Ampere portfolio, a bulk of the products are the lithium-ion high technology products. So that is one change. The second change is Ampere, when we acquired, was primarily a south-based company and had around 70 odd dealerships primarily in Tamil Nadu area. Today, Ampere has over 358 dealerships, exclusive dealerships, plus also sells through some of the Greaves retail dealerships. So in all, Ampere is selling through 500 plus dealerships today. And this is over around 260 plus cities all across the country. There is a very strong demand from the market, both in terms of product as well in terms of dealership inquiries. We have added 130 plus dealerships since the unlock process began last year. And the third thing which I would say is Ampere today has a facility at Coimbatore. We have anticipating this significant increase in market demand. We have in the last few months announced a EV mega site coming up at Ranipet. That will be a large volume mega site which will help Ampere transition significantly in terms of a very high volume manufacturer. The fourth part is control over supply chain. When we acquired Ampere, a lot of components were coming from being imported. And since then, we have been working on a very active localization. And today, most of our high-speed product portfolio has significant amount of localization and with very good quality vendors in India. It's an ongoing journey. We continue to strengthen that. And we have also actively taken up strengthening of the localization of the slow speed segment. The fifth part is we have built up the financing ecosystem throughout the country, which is helping accelerate Ampere sales. So these are the five key actions which we have taken. And on the customer side, both B2C and B2B, we are focusing on, and we have over 50 partners on the B2B side, and that segment is also growing fairly well for us. So these are the five critical areas on the two-wheeler side. And in addition, we have also expanded the Ampere portfolio to the three-wheeler side. Last year, we acquired a company which sells e-rickshaws under the LE brand, and that again is becoming a good growth driver for Ampere businesses. So I hope that answers your question.
Yeah, sir. So anything regarding R&D also I just wanted to know. Like, since there are like too many participants for the two-wheeler segment currently,
yes.
Anything you are going like out of box, like what do I say for that? Like mileage, like for EV, that is something which is very concerning. Currently, like most of the companies are just giving like 100-kilometer range, for the bike, like average I'm speaking. So anything in terms of R&D you are working on that, like something unique, like patentable thing which is only with our company, something like that?
So we are definitely working on technology, and in the first phase, as we have also mentioned in some of the previous investor calls, that a lot of focus has been in terms of improving the product capability and reliability. And some of this work is being done in-house. Some of the work we are working with strategic partners in each of these areas, and it is a constant endeavor to improve the product technology. Like last year, I gave an example before also that for our Magnus Pro, which is our flagship product, we introduced certain products which came from customer feedback, like limp home feature, wherein in the last 10% charge, the vehicle goes on to a power save mode so that the vehicle can deliver 10 kilometers additional range, so that the driver is not stranded in the middle of the road anywhere. Or we introduced a software controller-based hill assist features, where if the vehicle is in a traffic jam on a flyover, it doesn't roll back, roll forward. Similarly, every year we are improving the product capability. Our first generation Zeal to second generation Zeal, which was launched last year, there was a 10% improvement in range using the similar powertrain. So it's a continuous evolution, and we are working actively and investing behind the technology to improve the experience of an electric two-wheeler.
All right. Thank you, sir. Okay.
Thank you. We would request the participants to please press star and one to ask a question. The next question is from the line of Vimal Gohil from Union Asset Management. Please go ahead.
Yes, sir. Thank you for the opportunity. I hope I'm audible.
Yes.
Sir, my question was again on in relation to the previous participant's question on the competition that is coming up in e-two-wheelers. So basically, just an extension of that. I mean, there is going to be an onslaught in terms of the kind of capital the competition has, be it new players or be it the legacy players. I think everyone has very strong balance sheets. So if at all there is a scenario where there is cutthroat competition in terms of price, how do we plan to counter that? Have we thought about this? I have two more questions after that.
Sure. So in terms of capital, we have maintained that capital will not be a constraint for the growth for Ampere. Greaves itself has a strong balance sheet, and we have the ability to bring in capital. And if required, we are also open to bringing in external capital to fund Ampere's growth. So capital will not be a constraint of to growth. Like you rightly said, the competition is intensifying, and we expect more people to come into the market. So what we've done is we have been ticking off the boxes in terms of the basics. We have brought in a fairly strong leadership team at Ampere, which can drive the future growth for the business. Also, what we are kind of looking at is, in terms of greater control over certain technology. We have mentioned in the past that some of the software and the controller-based technologies, which are the unique to an electric two-wheeler, those are some areas where we will have greater control because it defines the experience of an electric two-wheeler. Another important thing that I think we should all appreciate is that electric two-wheeler market, which is less than close to 150,000 units, is expected to grow to anywhere between 3 to 5 million over the next 5 years. That is a fairly exponential pace of growth, and I would say that it offers space for multiple people to be in the market and grow. And I'm sure that if we are looking at this market in FY26, there will be some new age companies, there will be some traditional companies who would be there. And our intent is and our plan is to be there as a new age competitor in the market when we look at in FY26 with a strong positioning.
Right. The question was actually more to while your insights are well taken, sir. If at all the competition is sort of aggressive on pricing, will Greaves also look to be as competitive in terms of price, or will we maintain our premium sort of whatever? If at all we are at a premium to competition, we'll sort of continue to maintain that and focus on profitability or better quality growth. What would be our approach there? If that
Arun, I will take that.
Sure.
Yeah, just to answer the question, this is Nagesh. So clearly, Ampere backed by Greaves ecosystem, right? When I'm talking about Greaves ecosystem, in addition to the technology, the people, the dealership, that we also have 10,000 plus mechanics, 7,000 plus retail stores that can provide uninterrupted journey, right? So and plus we have Greaves Finance to back some of the financing needs. So when you look at the overall ecosystem or a solution is what the Ampere Greaves solution is offering. Point number one. Point number two, we continue to strengthen the team, continue to invest in technology. We play in the heart of the market. We have 75,000 customers and we've been in the market for 10 plus years, which means we understand the duty cycle requirements, right? So I am not going to answer a hypothetical, but enough to say that our value proposition will remain strong. Our product differentiation will continue to evolve, and our customer connect, especially our HOLA, HOLA, Happy Ampere's League of America, right? Happy
Owners League of Ampere.
Owners League of Ampere, excuse me. that will continue. That community connect will continue. That customer connect will continue. So I am not, we believe we offer a value proposition, and that value proposition, as you've seen, through the last 4 quarters has increased from being a slow speed to high speed, lead acid to lithium, pan India, over 260 cities available, right? B2B plus B2C. So I think our value proposition will continue, and that's kind of where I leave that.
Fair enough, sir. Sir, just on the financials of Ampere, if I observe this time around, our contribution margins from Ampere has sort of improved, but we are still not close to where the peak gross margins were in Ampere. So what is the outlook there? What is the sort of sustainable, contribution margins we are looking at for Ampere? For example, in this particular quarter, we have reported 20% sort of gross margin, which is a significant improvement from the last quarter. But I observe that we've done somewhere near 20, 28, 24 as well. So should we expect an improvement going forward, given the change in mix to high-speed scooters going forward?
Yeah. So in terms of margins, are a factor of two things. One is volume, and second is the supply base. So in the past few quarters, what we've done, like I said, we've accelerated our localization journey. We have started partnering with local suppliers and local vendors, which has exerted some sort of upward pressure on the costs, because that Indian supply base is still emerging. So I would say that it's a journey. We are hopeful that the margins will improve, but right now the thrust is on ensuring good quality suppliers and good quality components going into our products. Dalpat, you may want to add on that.
Yeah. So Arun, I think you are well covered. But coming back to the question, yes, in long term, the margins will go back to where it was. In fact, it can go higher than that, because this localization in short term will have some impact, but in long term, it will give more benefit than where we were earlier.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Ashutosh Tiwari from Inspirit Securities. Please go ahead.
Yeah, hi sir. Congrats on decent numbers. I think leaving aside electric three-wheeler diesel engine, I think across the segment we've done very well in terms of YOY growth or QoQ growth. The first question is on Ampere. What would have been the mix of high speed in this quarter?
So roughly, high speed, is close to 40% of our portfolio now.
Okay. And Ampere losses. If I look at electric mobility EVIT loss in this quarter versus last quarter, despite the fact that sales have improved, our losses have gone up. Any particular reason behind that? So I think the EVIT loss was 11.2 crores in the quarter versus 7.9 crores in the previous quarter.
Yeah. So Ashutosh, there is a 4.2 crore of a one-time accounting impact pursuant to India's adjustment. So that's a one-time component. The operating losses have reduced compared to the previous quarter. It has come down to below 7 crores.
Okay. And lastly, we are doing quite well in this non-auto engines as well. I think quarter on quarter we are seeing good growth for us. So just to understand the potential of this market, what is the size of market and what is probably our market share, and where we are looking forward to, where this volume can go to, and not is I don't know the exact numbers and all, but directionally where we are in terms of market share and what is the potential size for us.
Sure. So Ashutosh, this is one of the diversification areas which we have been very actively working upon on the non-automotive engine side, and now it has started to grow rapidly. In terms of the market, etc., this is a market which is steadily evolving, and like I've been mentioned in the previous calls, that one of the major drivers for this market expansion is moving, shift away from manual labor to mechanized labor. in various segments, be it light agricultural, light construction, or sanitation works, or various industrial applications. So the engines go into 100+ applications. So market is from manual to mechanized, and second shift which is happening is earlier a lot of lower cost Chinese engines were coming in, which are getting gradually replaced by better quality Indian engines as the markets have started maturing. So that is where I would leave. The overall market size and is still not very well determined, because it's a fairly large shift which is happening, and still the unorganized play is fairly large in this. But in the organized players, better quality products, we have started taking leadership position in this segment. But it's a growth story. It will continue to grow and expand as mechanization picks up in the country.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions. Also, we would request our participants to please limit your questions to 3 per participant. The next question is from the line of Amarkant Kaur from Phillip Capital. Please go ahead.
Hello. So thanks for taking my question, sir. My question is on localization. So what are your localizations levels currently, and what are the components that you have to you're sort of importing, and what will be your priority in terms of localizing the components that you're importing right now?
So in terms of localization levels for the high-speed scooters, we are following the guidelines, and the scooters are in very advanced stages of localization, and most of the critical components are from domestic partners now. The major component which comes from gets imported is the lithium-ion battery cells. Now, as you know, that India still doesn't have a lithium-ion cell manufacturing, so cells are getting imported, but the packs and the BMS is localized. So that is on the high-speed side. So on the slow-speed side, where there are no regulations on localization, there, as part of our strategy, we have initiated the localization journey. That may take slightly longer, but we are well on our path to localizing that as well.
Okay, thank you, sir. And the other bit on the is a little longer-term question. So we see a lot of new players coming into the electric two-wheeler space. So how do you see the industry shaping up in the next 4 to 5 years, say?
The industry is in expected to get into a hyper growth mode as we go ahead into the next few years. So I would expect more competition to come in. But the way we are considering ourselves is that we recognize that there will be certain asymmetric competition into this market. There will be some of the traditional players who will also expand their play on the electric side. So we are kind of focusing on the basics, what is required to be successful into the market, and also create a differentiation in the market through a stronger customer connect, through digital channels, through unique financing things, and ultimately it is the product and technology which needs to perform. So we have right now positioned Ampere in the 4 customer segments, which we say one is on the slow speed side, which is the housewives, the school children, the retired people who want cost, convenience, safety as a parameter. And then there is the office goer segment, and there's a B2B segment, and then there is a segment which requires higher speed scooters, especially in the urban market. And we are filling those product gaps. We have consciously stayed away from top of the pyramid, which is more of a niche segment with products which are 125,000 plus. We have consciously stayed away from that segment and focusing on the mass market, which drives mobility in the country today. So that's how we are approaching the market.
Thanks. Thank you, sir.
Yeah.
Thank you. The next question is from the line of Vasudev Banerjee from Ambit Capital Private Limited. Please go ahead.
Yeah, thanks for taking my question. Just wanted to understand few aspects. One, just the previous question, as you highlighted that still the value addition is still the imported part and rest are all localized. So, are your products now eligible under FAME 2 subsidy?
Yes. So our products, Ampere high-speed products, if you recall, we were eligible for FAME 2 subsidy, among the first companies who became eligible for FAME 2 subsidy. So absolutely, our products, high-speed products, which are covered under FAME 2, all are eligible.
Sure. So just from a long-term perspective, I was trying to understand that with cell localization coming up and FAME 2 subsidies for few players being there, if say by next 5 to 6 years, with petrol scooters, normal cost inflation going up, and the deflation of e-two-wheelers, so there's a convergence of the capital costs, say after 5-6 years. Do you see extra demand elasticity for the industry? So say ICE-based two-wheeler market size would have been X, and because e-two-wheelers are also coming in, rather than just mere substitution, the market size itself will expand because capital cost being same, TCO will be substantially lower, improving the affordability. So, as per your study, if you can highlight from that aspect, sir.
Sure. So very, very good point. So our expectation is twofold. One is, if you look at mobility in the country, mobility is still, unserved, unaddressed need in the country even today. So two-wheeler segment, barring last 2 years, which because of the NBFC crisis and then COVID have been slightly exceptional. The two-wheeler segment has been growing in India over a longer term horizon as well. So that growth will continue. I would say there will be two parts. In the higher speed, the product capability will keep on going up and the value proposition will keep on expanding. So the pricing levels may remain the same, but the value prop will go up. The second part to this is the slow speed segment play in an area where virtually no engine-based scooters are there. So that is a segment where people are shifting from walking and cycling towards entry-level scooters. So that will continue to grow especially in the tier 3, tier 4 towns and cities. Other two points in this is one is this entire B2B segment, which is e-commerce deliveries, food deliveries, as well as the concierge services and ride share. This is an entirely new segment which is opening up, and two-wheeler is very well positioned to serve this market, and this will also drive growth in the industry. So I would say that two-wheeler will continue to play an important role in mobility in India and and is likely to expand as we go ahead. So the industry is fairly attractive.
But if I see, sir, the lead-acid two-wheeler segment, e-two-wheeler segment, despite being in the market for almost a decade, and say the leader being there for a decade, selling near 50,000 per annum volume, and the market size is hardly 1.5 lakh after being for so many years.
Yes.
So, in the longer run, how to look at the lead-acid low-speed scooter stuff? That is it not accepted by the market at all, and it's just a mere presence felt kind of a stuff? The moment normal high-speed but affordable e-scooters are available, that would be the right product for the market to scale up, rather than the low-speed stuff at all.
See, low-speed scooters serve a particular niche market segment, especially in tier 3, tier 4, where these products are available at 30,000-35,000 rupees. So they have their own market, but what will start happening as the lithium-ion cost starts coming down, even some of those products will start gradually transitioning to better technology, lithium-ion based batteries. So that shift will happen, but India will continue to have a play in both slow-speed scooters and high-speed scooters. But high-speed scooters will grow much more rapidly as we go ahead in future. because they kind of close the gap between the engine-based scooters and electric scooters.
And last question, sir. When do you see proper localization of cell manufacturing also? Because if some new player is commenting on 10 million capacity, obviously such scale is only possible through local manufacturing down the line. It can't be at an imported cost. So how do you see building capability of local cell manufacturing and timeline?
So local manufacturing of lithium-ion cells will start in India. It's a high investment game, and there are some players who have already started announcing their plans. The government has also given incentives through PLI scheme. So there will be local manufacturing as we go ahead over the next few years. So I don't want to comment on a timeline on anybody else's behalf. But as part of our stated strategies, since the lithium-ion cell chemistry is also evolving fairly rapidly, we have stated in the past as well that we would like to remain cell agnostic. We won't get into lithium-ion cell manufacturing. It's the pack and BMS where we are looking at taking greater control going ahead in future. So whatever chemistry is suitable for the products, we will take the requisite cells from the market. Today it is imported, tomorrow it will be domestic partners.
Thank you. The next question is from the line of Naitik Modi from Overchand Portfolio. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, you said there are some 360 odd dealers, right? Is that correct?
Yes, so Ampere has around 328 exclusive dealers. Plus, there are certain there are Greaves retail outlets as well which sell Ampere. So overall, it is 500 plus retail points.
Right. So out of these exclusive dealers, how many of them are actually active, and how do you define active internally?
So most of our dealers are active. So they may be at various stages of evolution, like I mentioned, that almost 130 out of that have been added in the since the unlock process began in H2 last year. So, but most of the dealerships are active today, and active is defined by their regular purchases.
And typically, what is the profile of these dealers? Are they existing dealers of auto within the automotive segment, or
it is a mix? It is a mix. There are certain
viability is a issue, right?
So there are two parts. One is the dealerships are configured in a way that the initial capital requirement is on the lower side. Also because unlike an engine-based two-wheeler, electric two-wheeler, the service requirements are also fairly lower. So they are not built on life cycle value extraction. So we have consciously factored that in and kept the initial investments low. The second part is most of the dealers who are also coming in recognize that this industry is at a cusp of significant expansion going ahead in the next few years. So they are also people who are willing to stay with us and stay invested over a longer term. But the very fact that we don't see much dealer attrition also shows that dealers are meeting their viability and are willing to stay invested with us. So we have a very strong dealer demand.
Okay. And as you said that traditionally Ampere as a brand was more of a south-based brand.
Yes.
So please first give us the revenue split for region-wise for two-wheelers.
So I would say that, we don't give the region-wise split. I would say that from Tamil Nadu now it has expanded to entire southern market. West has picked up. North and east are the areas where we are now focusing on expanding our penetration.
So it is fair to say that most of the revenue is primarily from south and west.
And that's also true with the two-wheeler electric auto market as well right now.
The three-wheeler market is much stronger in the north and east because that is where the bulk of the e-rickshaw market is there today.
Okay. And what is the revenue split between two-wheeler and three-wheeler for us? For the
So
21?
So typically revenue split we don't give, but the volume split we have given in the presentation.
Yeah. So the three-wheeler company is a part of Ampere. Is that correct?
It is a subsidiary of Ampere, yes. Ampere owns 74% in the three-wheeler company.
So in the Ampere balance sheet, it is consolidated.
Yes.
All right. Thank you, sir. Thank you very much.
Okay.
Thank you. The next question is from the line of Amitabh Chakravarti from Kitara Capital. Please go ahead.
Hi, am I audible?
Yes, please, you're audible.
Yeah, thank you. Thank you for taking the question. See, what we are seeing is a diesel engine, there is a slowdown, right? I mean, in your segmental thing. So is there any plan to go for electrical three-wheeler? Because I believe that the strategy, I think, is there any strategy towards that? Because you have been into E, like Ampere, it is two-wheeler and e-rickshaw now. So what is the strategy on the electrical three-wheeler space? Passenger electrical three-wheeler space.
Sure. So like you said that the three-wheeler auto engines has gone down in this year because of various pandemic-related shared mobility concerns. And our strategy till now has been, we have looked at two-wheelers, we have looked at e-rickshaw. And as the market starts moving towards our philosophy is that as things start getting ready into a commercialization ready stage, we will look at that. So three-wheelers, right, electric auto rickshaws is something as part of the future, and at the right time we may discuss that as well. But right now our thrust is more towards electric two-wheeler and electric rickshaws, which are expanding rapidly and are larger parts of the market today.
Okay, thank you.
Thank you. The next question is from the line of Bhargav from Emkay Global Financial Services. Please go ahead.
Hi, sir. Thank you for the opportunity. Am I audible?
Yes, please.
Yeah. So I wanted to know about the capex plans for the next 2 to 3 years, if you can give any guidance on that. And wanted to know how much of the percentage would be more on the e-mobility part. And the second would be how many of your Ampere vehicles are financed, as in a percentage of sales?
Hi. So Bhargav, let me take the first part. In terms of the company's capex plan, as you know, in the GCL standalone, we have spent around 40 crores in FY21, and capex around that should continue as we move forward. Around 40 to 50 crores of annual capex, depending on the market conditions. About e-mobility, we had announced 700 crores of total investment in capital and working capital over a period of 10 years. So that will be more or less proportionate as we go forward in next 3 to 5 years' time.
Okay.
Yeah.
Arun, you may want to answer the second part about the financing of vehicles.
Yeah. So on the financing side, the financing penetration is gradually growing. Till for the past 2 or 3 years, when Ampere had a much more dominant slow speed segment, there the financing levels were fairly low because the slow speed vehicles are not registered. So that is where the financing penetration is low. But on the high speed side, it is gradually picking up. We don't want to give the exact numbers, but it is starting to become an important constituent on the B2C side. So, but the industry, I think, is numbers are almost 30 to 40% are the financing levels on the electric two-wheelers, high speed.
Okay. Thank you very much, sir. Thank you.
Thank you. The next question is from the line of Jay Shankar Nair from IIFL Asset Management. Please go ahead.
Thank you, sir, for taking my question. Hope I'm audible. My question was in terms of segment, I mean, standalone, on console segment, look at engines is currently 48%. Any sense, I mean, a broad sense is also fine with regard to auto and non-auto engine and how the absolute number has actually changed. I mean, if you can give some sense, because what we are observing is that the auto engines are actually coming down and non-auto engines are disproportionately going up in terms of your volumes what you disclose. To get a broad sense as to how much it will.
That's what you want to take that?
Yeah. So the change in the auto composition is linked with the temporary COVID situation, and as we know, shared mobility has come down significantly. And within the auto overall three-wheelers, passenger vehicles contribute a significant part. Overall, from last year, it has come down from 54% to 48% in terms of overall engines business revenue. And within that, composition of non-auto has increased this financial year. Next financial year, we expect with the recovery, we should move back to where it was, though non-auto applications will continue to grow faster because we have increased offerings out there with smart IoT-based engines and all. But overall, auto engines will continue to have dominant share in the overall engines as we move forward.
So that is one part, and also, if you look at a longer time horizon, engines business as a portfolio used to be 75% plus for us if we go back a few years in the past. So we have steadily been de-risking this, but like Dalpat said that as auto engines come back in the later part of the year, this will go back slightly up. And within this segment, there will be a diversification between auto and non-auto, and I think some of those are visible in the numbers, the volume numbers.
Yeah, but would it be correct to say that of the total 520 crores in the quarter, 10 to 12% would be non-auto engines?
Yeah, those volumes are there in the presentation, and you are right. That's the kind of share which is there.
And my second question was with regard to the on the cost front, at least on the standalone numbers, which post the Ramikhet, your costs had actually come down in terms of employee and other expenses, and we are seeing it actually moving. So is it the more sustainable number what we are seeing in the current quarter, or is it there is an impact of seasonality on it?
So overall overheads have come down by 16% in FY21. Out of that, I would say, as we had mentioned in the previous earning calls also, there will be minimum 10% of reduction in the fixed cost base, and that is something which is sustainable. Some part of the 16% reduction will come back because those were related to travel and other COVID-linked reductions.
Yeah, and one last question with regard to the tax rate was unusually high. Any particular reason for that in the current quarter?
So there are, because of PBT being smaller, there are few items like 43B or CSR, right, which continued at the same amount. Now, they as a percentage of PBT, taxable PBT became a higher percentage. So nothing in terms of structural change. It was more the base becoming a smaller one this year.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions. The next question is from the line of Aditya Makharia from HDFC Securities. Please go ahead.
Yeah, hi. I just wanted to understand what is the new capacity which we are setting up, and what is the capex and the timelines for the same. Thanks.
Yeah, so I think your question was for the electric vehicles part. So in terms of the capacity, what we've announced is that this plant can go up to 1 million units, and there is a potential to go up even further as we go ahead in future. And we will do it in phases. The initial part will be on slightly lower, but it will get ramped up. And like Dalpat mentioned earlier, that we have committed around 700 crores of total capital and working capital investments over a 10-year horizon for this business.
So by investing 700 crores, you can reach 1 million units. Is basically what you're mentioning. So the capex will be staggered.
No. So yeah, capex will be staggered, and for reaching 1 million, you don't need capex of that. It's a combination of capex, working capital investments overall. We are not giving specific breakup. As you know, there are sensitivities around that number. But overall, capex is going to be a smaller portion of that 700 crores.
Okay, and you mentioned that you're localizing by, only the cell is what you will import, and the BMS and everything else you will make in-house. So does this factor all this localization also? These you are buying from vendors?
So one correction, not everything will be in-house. We have developed strategic vendors, and as the volumes pick up in future, we will look at selective make versus buy. But right now, we are working through strategic vendors.
Okay, which includes for the BMS as well, right? That's where you have a strategic vendor.
Yes. Today we are working through partners.
Okay, so it's a fairly asset-light business. I mean, that's just what I was trying to get at. If you're going to be reaching a million,
as a founders.
That's correct.
But as we go ahead into the future, certain key technologies we will take some control in-house, and we will announce that at the right time.
Okay, got it. Thank you.
Thank you. The next question is from the line of Chetan Vora from Abacus Investments. Please go ahead.
Yeah, good morning, sir. Wanted to understand your view on 2-3 pointers. First of all, on the engine business, which is roughly 50% of our volumes, even in FY20, would like to understand your view, how that will be shaping up going ahead. And the other two things were the quarterly thing, wherein we saw the employee cost and the other expenses on a QOQ basis have increased quite sharply. The other expenses have increased by 12 crores from 44 to 54 crores. Just wanted to understand whether there are any one-off, and even on the employee side also, the employee cost has also increased from 29 to 35 crores.
Yeah. So Kunal, it's a natural classification under our published results. So total increase is 16 crores between both these heads. Out of 16 crores, 5 crore is linked with the revenue growth. There are 7 crores of expenses which are one-time nature. So gratuity because of discount rate coming down, overall actual provisions going up, and those kind of things. 3 crore is a recurring cost increase in this entire 16 crore.
Okay. And on the engine business?
Yeah. So, Ajit, do you want to take up for the automotive part? So, Chetan, we did see some green shoots towards the end of 2020. But the second wave has and the ensuing lockdowns will likely hamper the growth in the short term. And we expect that the first quarter may be impacted because the lockdowns have started since 15th of April. And it is a little bit of a prediction, tough to predict what will happen in the first quarter. Second quarter, we expect it to be better. And with demand resurging, hopefully once the lockdowns are taken off and the vaccinations in place.
Okay. And whether that would be applicable for both the things, the auto thing and non-auto as well?
On non-auto is less impacted to a lesser extent with the lockdowns and personal mobility. The three-wheeler segment is far more impacted because of the social distancing norm and the restrictions. The goods carrier part of the three-wheeler is a little bit more robust in terms of taking on the COVID-related restrictions. Whereas in the non-auto segment, yes, it is getting impacted, but not to the extent of the three-wheeler. Yeah, and for the non-auto segment, if you look at the volume summary, that segment has been growing fairly rapidly. So, like I just said, it's a slightly lower impact, but higher impact is on the passenger three-wheeler side, where because of the social distancing and the pandemic-related concerns, the entire industry has nosedived.
Yeah, lastly, and are we seeing any structural challenges on the auto thing because our portfolio was more of on the diesel side, and that segment has been not been able to grow, wherein in the passenger, which is largely a petrol and / CNG. So how do we cope up with that?
Chetan, we are looking at expanding the range of offerings. In terms of diesel itself, we have LOI we signed up a LOI with a new three-wheeler OEM. We have also got a four-wheeler microcar segment international OE who has signed up with an MOU with us. In addition to that, we are also looking at expanding with the new opportunities and entering new segments as well.
our CNG portfolio is also quite strong, and we will be launching a product with one of the large OEMs this quarter.
Okay. Okay. Thank you.
Yeah.
Thank you. That was the last question for today. Due to time constraint, we would request all other participants to please email their queries, and the company will revert as soon as possible. I would now like to hand the conference over to Mr. Nagesh Basavanhalli for closing remarks.
Yes, thank you. Thank you all for joining us on the call. Please feel free to reach out to us if you have any further questions. In summary, we believe that some of the actions in terms of capability and addition in terms of the product portfolio and focusing on the clean mobility at the bottom of the pyramid, and doing some of the things that we control even in these tough times, will augur well for the future. So we remain committed to this journey, and we thank you all for joining today. Thank you all. Have a good day. Stay safe. Thanks.
Thank you.
Thank you. On behalf of Greaves Cotton Limited, we thank you once again. Stay safe. With this, we conclude this call. Thank you for joining us.